Hi, everyone, and welcome to this month's edition of On Track. It's 24th of October, Friday morning, as I record this, fresh from the Care Investment Committee meeting yesterday in Sydney. So we've got news and charts all up to today and the performance to the end of September. Um, Firstly, as always, just a quick general advice warning. All the information in here is prepared to the best of our knowledge. It may or may not be suitable for you, but you should get advice or talk to your advisor before acting on this. This is prepared for clients, predominantly of McGregor Wealth, who use our care investment process. So let's jump in. We're going to cover all the usual stuff. And as always, there's never a dull moment in the world. Lots going on. Continued market volatility. You can see the S&P chart down the bottom of the screen here. But a little bit of, we had that big red gap day. That was when Trump announced he was gonna retaliate and have huge tariffs on China because they were making noises about restricting the supply of rare earths. And rare earths are these they're not actually very rare for a start. They're just hard to extract. Well, they're not extremely hard to extract. They're harder to process. And China spent 20 years building up processing capability. It's a messy, dirty thing to process these minerals. Why are they so important? They're fundamental to energy transition. A lot of electrical energy relies on magnets, and the metals that go into magnets are these rare earths, amongst other things. That's very simplified. And so, yeah, China flexed a bit, announced they were gonna, put some potential restrictions on that. And Trump retaliated straight away. Markets dropped, but then the language, as often happens with this, got softer and markets have sort of slowly come back a bit there. There's still a lot of trade tension around. The market keeps looking through it, but it is a handbrake. We don't know how this all plays out still. So every bit of downside uncertainty seems to be around the trade tension. There's also how much inflation that means. I saw some headlines during the month that Canada is on the verge of recession. I mean, they're not quite there when I had a look. Um, and that's because they're suffering from some of those tariffs. That's one of the reasons, at least. The UK is on almost no growth. I've got a chart down there, the bottom. Yeah, we've got this mixed growth around the world. The OECD raised their growth estimates for the world up to 3.2%. I think it was about 3%. So it's not, no, there you go, 0.3%. So they did have 2.9. So there's a lot of increases there. But if you look at where most of the growth is coming from, it's coming from those developing countries rather than the developed world. India at 6.7%, which is why we like India a lot as a growth engine. China at 4.9, still incredibly solid, even though it's down from their glory days of 7 to 10. And I should point out these are growth rates, so growing 4.9% on a much bigger number is still good for the world. Indonesia, a powerhouse that we don't talk about enough, and one of Australia's closest neighbours, growing at 4.9%. So the average for the world at 3.2, but then you can see the US at 1.8, UK at 1.4. Australia's not in this one, but I think we're only in the ones. So, it's sluggish growth for most of the world. You've heard everyone talking about not enough productivity growth. But it's okay. And underlie that, we've got the technology boom, AI, robotics, etc., which is keeping the share market running hot. I'm going to talk more about a lot of that stuff. Um, on the flip side of that, and related to that China rare earth stuff, Albo went off to visit Trump. We all held our breath, wondering whether Trump was going to make a fool of him or not. And the outcome was pretty good. The joker or the jester was Kevin Rudd, but look, it looks on any objective basis like a good outcome. Positive comments from Trump that recognise Australia's deep long-term strategic relation with the US that's been based on defence and everything else. So we've got to remember though that China's our biggest trading partner and the US is our most important security partner. So we've got this awkward dance between China and the US, trying to keep them both happy, which is hard, but a good outcome from that meeting. What will be interesting to see is if we can. China's taken 20 to 30 years to build up the processing capabilities on these rare earths, but they dominate. It's something like 80% of the rare earth processing happens in China. So that means countries like Australia, and there's plenty of these rare earths in Australia, there's plenty in South America, but we dig it out of the ground, we ship it off to China for processing. So hopefully the biggest, most important outcome of these trade talks is Australia will invest heavily in processing capability. And by the way, this doesn't happen in 6 months or even 12 months. This is going to take time. Um, and with the US, very keen on seeing this processing capability develop outside of China, that hopefully will be a good thing for Australia. It's ironic, though, in making all this clean green energy, the process required to process these rare earths is extremely messy, toxic, and creates a lot of pollution. So it's always that elephant in the room around energy transition. I'm not going to go there, but the world is transitioning, and this is good news for Australia, hopefully. Yeah, earnings round in the States, over 75% of companies beat their earnings expectations for quarter three, but where they missed, they were punished. So the share market pushes down. The share market wants to see growth. It actually needs to see high growth from these big tech companies. Otherwise, the share price is not justified. So any of those big companies that disappoint will be punished. But there's, on average, 75% is a good number that beat expectation. Just walking through the numbers, no change in our cash rate. I don't have it here, but the US Fed did cut their cash rate. They talk about a range. Their range is 4 to 4.25. You can see ours at 3.6 is still below. So you still get more for your money, more cash, more interest on your cash in the US than you do in Australia. I think, yeah, the markets are still predicting cuts of 0.5% on average in Australia and the US. I'm not so sure that happens. We're starting to see little bits of inflationary stuff, although the drop in oil prices in the last month has substantially helped inflation. So maybe we do see it. But yeah, I think people that are hanging out for all these reductions probably want to plan that rates might be getting close to their new normal now. So we see that as we go down the bottom here at mortgage rates and term deposit rates, term deposit rates at 3.64. Yeah, I think that's the new normal. There's a chance it goes down a bit more, but we're probably in that mid threes as the normal there. Mortgage rates, yeah, the headline rates are in the low sixes, but the actual good rates are in the mid fives. And there's some variable rates on offer at 5.14, only for 1 year or 2 years. But it's a good number. For many of us in our lifetime of investing, 5% interest rates sound amazing. For people fairly new in the markets that got spoiled by a few years at 2%, these feel a bit high, but I feel like we need to consider them as normal. Maybe they go lower, but possibly not as well. Not much change on anything else there. Returns, yeah, really good for the month. You can see, as I don't normally scroll down the month, but yeah, and keep in mind, monthly figures don't really matter. They can be all over the place. But the one standout there was the active portfolio, which jumped 4%. Now that was mainly off the back of gold, but other things contributing as well. You can see high growth up 0.8%, multiply that by 12, so it was growing at that annualized rate of 10%. So it's not crazy high, it's just solid. When you look at the yearly results at the moment, high growth portfolios at about 13 to 14, growth at sort of the 13, 12s. These are good solid numbers. They're not crazy. Yeah, and when you go out to 5 years, the average is high growth, yeah, nearly 12, growth 11, balance 10. Good numbers, not super crazy, but above average, long-term average, those targets on the right that we assume. So say for a balanced, inflation plus 4, as that minimum, up to inflation plus 6 for growth. Lots of our planning's done around inflation plus 5, comfortably being hit over 10 years, but not so far over that we're worried about markets being crazy territory. We've still left the dial at 10. Maybe we're slightly above a 10, but we're not quite at an 11. So markets, while being expensive, still have plenty of momentum. There's a lot of money flying around the world in retirement savings and other things, and it's got to find a home. With cash rates falling to 3, people turn to share markets and property markets, so that keeps them in demand. I'm going to talk more about, yeah, are we in a boom? Is it a bubble? You start to hear more talks about bubbles, particularly in things like the tech stocks. But yeah, that word comes up more frequently. I'll touch on that in a minute. It fits into our rhythm of the market cycle, that boom, bust, and wall of worry, or fear and FOMO, and both are fear. And you can see, I would still say we're squarely in the wall of worry. We're on the verge of a potential boom, but it keeps correcting through whatever worries are around. We had that correction last year. Yeah, we're possibly due for a correction of 5 to 10 to 15% at the moment, particularly in that tech space, but they're normal things that we don't try and anticipate and get out. We just, apply our process, which is keep the reserves up to date, keep some powder dry if you're still growing your wealth, keep your dollar cost averaging going. But yeah, still wall of worry, just a little bit expensive. I thought I'd focus in on bubbles because you will be seeing in the news people starting to talk about it. So if we look at the chart on the left here, which shows, the stages of a bubble. So, and yeah, it's stages of the market, really. Bubbles are rare. They only happen every 20, 30, or 40 years, a true bubble. And they often happen not in the broader share market, but in a subset. So what I'm looking at on the right-hand side here is NASDAQ. So let me walk through the stages first. But you've got the emergence. The market starts to tick up. We get this awareness and people go, oh, this is going well. Wow. And they think it's going high because we've had a period of downturn. And then you get these sell-offs. They've called that a bear trap. So that's where it starts to go down, and all the negative people say, see, I told you it was going to crash. But it's not really a crash, it's just a dip in the wall of worry. And obviously, you can get a lot of those. We saw this, the middle chart on the right-hand side is NASDAQ. All three on the right are NASDAQ. The top one is the NASDAQ bubble of the late 90s, early 2000s, and the bursting. And that was a spectacular bubble. You'll see from 98, the market went from just under 1,000, 97, 98, and by 2000, in 3 years, it had gone to nearly 5,000. That's 5 times. Now, our All Ordinaries Index, yeah, even 10 years ago, it was about 5 or 6 thousand. Yeah, that's like it going to 25,000. So that's a bubble. What we've got is a boom. So it's nowhere near in the league. And underneath that on the right, you can see NASDAQ for the last couple of years. And it's going well. It's definitely in a boom phase, but it's more reminiscent to me of 98, 99, not 2000, where it just went vertical. You can see that red arrow in that top chart on the right, where during, from October 99 through to about April, so about 5 months, NASDAQ went from, two 2,200, 4,750, so it doubled in about 7 months. Now that's bubble territory. And it equates to, back to the chart on the left, it's because it's emotional. So, when the market starts to go well, there's a lot of media attention. People start to say, oh, my super's doing well, shares are doing well. And then you start to get the bears, and the bears are just the people that are always cautious about the share market. They start to say it's expensive. And they're right, but it's going to get more expensive. So nearly all the people talking about bubbles at the moment are the ones that are deep value managers. And because they're always cautious, they're often behind the game at this stage of the cycle. So they're underperforming. Nearly 90% of active managers in the last year in Australia underperformed the market because they were out of the market to some degree, which is why we're so cautious about ever being out of the market. The biggest risk always is being out of the market completely. And then we get into this enthusiastic stage where people that wouldn't normally be into shares start to get into shares. It becomes the topic at a barbecue, at any social event. People are talking about shares. Now we're clearly not at that stage yet. It's not something that people talk to me about. I know for the bubble stages that I've lived through in my career, when you'd hop in a taxi, when taxi drivers still talk to you, they'd be, and if they asked you what you did, they'd immediately want to know about what was happening to different companies in the share market. that is so not the case at the moment. So we're nowhere near what I would define a true bubble. Yeah, the US market has doubled in the last 3 years. Now that's pretty hot, but it's not a double in 6 months. Yeah, which you've seen a lot of these types of bubbles. Now, eventually a bubble crashes, returns to earth, but for the long-term investors, it goes back to that average long term. The chart down the bottom right here I put in because it shows we've got NASDAQ. It's a log scale. So you can see, if you can see, but I'll talk it through that massive boom to the top of 2000. But if you just held on, even though it went down 85%, NASDAQ from the peak of that boom is up 5 times in 25 years. That's a great investment. So even if you just rode through that volatility, if you made no attempt to predict it, yeah. So, and what do? We have trimmed back our holdings in the active portfolio. That is the place where we do that. And just getting back to those returns, that active portfolio has a return of 11.7% over 10 years, which is outstanding. We've only made 5 decisions over that period of time. And we haven't got them all perfect, but they're defensive decisions where we say, you know what, the risk reward, there's probably a chance to buy back in here a bit cheaper. So in the active portfolio, you may have noticed we're out a little bit more of the international shares and Aussie shares. And we expect there'll be a chance to re-enter that somewhere in the next year at possibly lower than where it is, but we're dodging, potential risk. We don't do that in the core portfolios because it's too dangerous to be out of the market. But we do trim a little there, and we'll see how that goes. In the exciting life, boring money part of the presentation, I've continued on this theme around private credit. A lot of the private wealth managers deliberately use private credit, private equity, some for good reasons. These things can deliver really good returns. But as I've talked about, there's been a mass flood of money into these things. Wherever there's a flood of money into anything, that lowers the deal quality. So it increases the risks of bad behavior and bad results. So ASIC's been all over this at the moment. And in this headline, ASIC reports race to the bottom on Australian private credit. So they're turning up the heat. And all the people in the market make noise that this is a really good thing because they don't want to say that their thing, but it's exposing, the report that ASIC's done called out issues in relation to hidden fees, conflict of interests, mass loan losses, and questionable value practices. So if you picture public credit, which is the banks, so it's public because it's listed, private is unlisted. So the banks have to report to APRA, their regulator, on any loan arrears, any loans that are more than 90 days old, in terms of payments behind. So it's very heavily regulated. Private credit does not have to do that at all. So sometimes these companies are pretending the loans are still fine. They're still counting interest income as income, even though it hasn't been paid. And in some cases, they're even turning those loans into private equity as to investments in those companies, even though they're failing. And we're seeing every month or two at the moment, there's a body floats to the surface on one of these companies that is in a bit of trouble. Now, it's not across the whole industry, but wherever you see an interest rate, a fixed income interest rate that's more than 5 or 6% in its promises, it's private credit. And that means they're lending to people that are riskier than the banks lend to. And there's also the question of fees. Sometimes they might be promising returns of 7 to 10%. They're taking fees of anywhere from 1 to 5%. And their fees can be hidden. They might say there's a 1% management fee, but they've also got due diligence fees, placement fees, and a raft of other fees and sometimes they're lending money to related party companies. Sometimes they're lending money they might also have a private equity fund and they're lending money to that. So these things, if they're good, they're fine, but if they become slightly doubtful. So it's an area we're avoiding completely at the moment. We think there's a place for private credit, but we're happy to be well out of that. And we'd rather use public stuff and managers like Realm. And if I go back to our returns here, and you look at our reserves portfolio, which is 50% 90-day bank bills and 50% Realm, And over 3 years, it's had a return of 6.7% when, yeah, the average, and that 3 years goes back to when rates were like 2% up to where rates are like 4%. So it's a really good return without being crazy spectacular. We don't, and yeah, and Realm's goal is to achieve returns that are 2 to 3% over cash rates, something they've done very successfully and very consistently over the whole time that we've been using them. So getting back to the charts, US cash rate dropped. You can see that in the top chart. The green chart shows US rates dropping, but rates are still, the US, there's a pattern down. Australia's sideways. Our 10-year bond rate at about 4.23. You can see in the bottom right-hand corner, the US 10-year bond rate is lower than ours, even though their cash rate is higher than ours. So their yield curve's a bit flatter. It's all a bit boring at the moment. Boring's okay. No major movement. And we certainly, starting to think, well, that's the new normal for bond rates in that 4 to 4.25 range for 10-year bonds. And yeah, so you're starting to see a pattern getting 3 to 3.5 on good cash, 4 to 4.5 on 10-year bonds. That's the new normal. So if you see rates of 10%, that's highly risky territory. Yeah, I won't touch heavy on that to say we're comfortably in the wall of worry, but at the expensive end at the moment, markets making new highs. And the dial at 10, and you can see, let me just talk about the dial for a minute. It goes from fear to FOMO, from 0 to 14. So I would expect that if we got to a stage that was similar to the boom I was talking about there in the NASDAQ boom, where markets had doubled in less than 18 months, we'd be at a 14. At the moment where US market 3 years, Aussie market 8 years, it's a 10. That just means it's expensive. Markets can be expensive for a long, long time. So you never dodge markets completely, and they always recover. So this slide is in here as a constant reminder that whenever you see these red zones, these big drops that range from 22 to 50% for the worst 9 since 1900. So 20, the least worst on here is 21%, and the worst is 50. Do we get a 50? They're 49, and that's top to bottom drops. But what you notice on every single one of those after the red drops is this recovery. So the markets go up in every single case. So, and this is why long-term investing is about the patience and the discipline. And then it's just trying to make sure we manage our behavior to not make bad decisions when we hit these red zones. So everything we do around the active portfolio, everything we do around reserves is to help you have confidence so you don't make bad decisions when an inevitable, it's crisis occurs, and they are inevitable, but 9 over 21% in 125 years, do the maths, 120 divided by 9. So yeah, every 15 years or so, if I've done the maths smart there. So in our most investors mess it up, we got the ways that people do mess it up over time, and that's confirmed by the Delbar numbers, which I've been following for literally 25 years now, that always show the same thing, that the returns that investors get are way less than the returns that their investments get, anywhere from 2 to 5% in any year. Over the 30 years up to 2023, it was 2% under. 2% is millions of dollars over your lifetime. Now they do that because of all these ways that people mess it up. The one I've highlighted for this month is illiquidity. So private credit, private equity, what happens is they're not liquid. If you want your money, sometimes I'll give it to you, but if they start to have problems, they won't. We saw we've currently seeing a bunch of clients coming to us who are with another advisor, with another group, and there's a whole lot of frozen investments, and these are around that private equity, private credit space. So they haven't failed, but they're frozen. They can't get their money out. So then they've got to pull money out of other areas. And yeah, there's only three ways, as I say, that people lose money. One of them is if you have to sell when markets are down. Now, if some of your investments are frozen, then sometimes you've got to sell investments that you didn't want to sell. So it's good to avoid all of that. In our behavioral biases this month, I've gone back to one of my favorites, which is chasing past performance. So it's very easy to say shares are doing really good. I like them at the moment, but that does not tell you what's going to happen next year. And you can see this colorful checkerboard here, which shows the performance in order from top to bottom each year, and there is no pattern. I mean, yes, shares appear closer to the top more often than not. And in the last decade, US large caps have done very well. So they're often at the top, but then they can be at the bottom, like in 2022, where after 3 years of being in the top three, they went down 23%. I feel like we're in that sort of potential at the moment, where large cap US stocks have the potential for a downturn of 10 to even up to 25%. But that's fine. That's why we have diversification. And when we go through the returns in a minute, you'll see the great returns that are coming from emerging markets and others. And that's why we believe in beautiful, boring diversification. And the biggest risk, as always, is our own behavior. And in booms like this, it's getting too aggressive and speculating or borrowing too much into the markets. And that eventually leads to results that are worse than the market results. When people borrow in a bull market and it goes over the cliff, take that NASDAQ market. Yes, it went up, but when it went down 85%. So if people had borrowed money to put into that, they got wiped out completely, which is what happened back then. So managing our behavior, avoiding bad decisions, making good decisions helps us to not mess it up. Let's have a look at the key sectors. So Aussie shares, slightly negative for the month. You can see it flatlining a little bit over the last 3 months, but still up 10.7% over last year and 10% over the 10 years. That's pretty average. And we've seen the ups and downs there. And that 10% over 10 years, you can see turns the value of $10,000 into 25,000. So yeah, great results for the compounding that we get. US shares up slightly for the month, and they've gone up a bit more since. You can see the stellar returns over 1 and 3 years. That's why we're a little bit cautious around those, and why in the active portfolio we've trimmed a bit. In the core portfolios, by the way, we're rebalancing constantly. At the meeting yesterday, we'll be selling a few shares and buying some bonds because the markets have gone back up again. So those little rebalancings make money and they keep reducing the risk. But yeah, the 10-year return there at about 15%. Yeah, and that's about 5% above the long-term averages. So that would tell you to expect less for the next 10 years. We might be expecting 7 or 8% over the next 10 years, but that's just on mean reversional averages. There is a chance that with the tech boom that we're having, that we actually get higher returns because of genuine increases in productivity and profitability that will come from the technology world, which you would think is inevitable, but it's got to be delivered. And in all these cycles, markets usually go too far, like in that NASDAQ, but we're nowhere near too far at the moment. We're at expensive, but not too far. Global leaders, much the same as the US, because the key global leaders are US stocks. So you can see that's Nvidia, Microsoft, Apple, Amazon, Broadcom, Facebook, etc. That magnificent seven. US small caps, more like the Australian market, up 5% for the month, which is good, but a pretty average year at 7%, a good 5 years and an average 10 years. Solid return, 10,000 to 25,000 over 10 years. Emerging markets has been, for a few years, the returns were very ordinary. Now, that was while other bits of the portfolio were doing well, but in the last year, emerging markets have delivered 20%, which is a nice boost. And if you recall from the start of the presentation, those OECD countries that are growing the most, India, China, Indonesia, all form part of emerging markets. So this is why we hold emerging markets. We expect those sectors to grow higher than others. And then we had gold, and gold has just been crazy spectacular. It's since the end of the month, it's gone up further, but then it's dropped. You would have seen footage of people queued up at the bullion office in Sydney to buy gold. That was almost a signal for professionals to take some profits, and then it dropped. That's typical of that bubble behavior. I wouldn't say gold's in a bubble, but it's certainly at the expensive end of the market. We hold it regardless because gold is first and foremost to us a currency hedge. As developed countries have higher and higher debt, what would normally happen is they would their currency would get weaker against other currencies. But when you've got all the leading countries with too much debt, they can't get weaker against each other because they're all weak. So what happens is they get weaker against gold. But if you flip that around, that just means gold price goes up. We think that's an important theme for the next 5 or 10 years. So we think even though gold's had an amazing run, it will probably continue. Keep in mind, there's a massive opportunity cost of holding gold. It produces no income. So it's an insurance part of the portfolio, not a key part of the portfolio. It's a defensive part. We're happy to hold it, but we wouldn't want to hold too much because then you don't produce any income at all. Into the property market and our boom bust boring cycle. And when I tweak the headwinds and tailwinds this month, yeah, I've added to the falling interest rate ones. That's keeping the price pressure up. I know I've got kids focusing on buying properties at the moment because interest rates have made it more affordable. But we've also seen it just automatically increase the values because there's lots of other young people chasing. So it's not really changing what they're getting. They're just paying more and borrowing more. But I've noted where will interest rates stop? Because I don't think they're going to drop a lot more from now. So whatever you can afford now is what you can budget in. For our investors, we're looking at potentially locking in 5-year rates. Just if you can afford it, there's two reasons you lock in rates. One predictive, which is really hard, but if you can afford it on investment property at the current 5-year rates, then that gives you predictable cash flow for the next 5 years, which means you'll never have to sell that property because interest rates spiked or whatever. Now, this upward cycle at the moment is being driven by that undersupply. And I was reading, depending on the articles you read, but Australia needs about 240,000 new homes a year to just keep up with population growth. I'll show you a chart in a minute that looks at where we're at with that, but we're not delivering that. So we're not filling up. We know there's a supply gap right now, and we're not catching up. We're at best just hanging in there. So that's not going to change. That's going to continue to provide tailwinds for property. Yeah, and the increases we've seen means the average across Australia for the last 5 years is 60%. So great for investors. But I've noted there beware of averages, and I'll show you the difference between the capital cities over the last 5 and 10 years in a minute, because they're vastly different depending on the capital city. So you've got to be very careful with average numbers, but the averages are good. And that undersupply is gonna persist for a time. We're not hitting those targets, and you can see on the left-hand side of the page here, this is private dwellings commenced, and we need to be north of 20,000, yeah, a month, and we're just there. But yeah, it depends. So, and this is seasonally adjusted. But you can see it's flatlining. So since 2023, it's jumped a bit, but it's not really going anywhere. So it's not going to fill in the immense gap we've had. So there's still it's helping, but it's just hanging in there. And then on the right-hand side, we've got where markets have peaked or where they're peaking, and Sydney, Brisbane, Adelaide, Perth, and Darwin are all at peaks. Then we look at but Melbourne peaked in March 22, as did Hobart and Canberra. So it's a good example of how markets at different stages. And if you look at the 5 years and have a look at the top return, which is Perth, we're lucky we have quite a few clients that bought in Perth over that period based on the good advice of our friends at Performance Property. But then right down to the bottom at 15% for Melbourne. So Melbourne's had its own problems. 5 years ago, it takes us to the end of COVID. Melbourne did COVID probably worse than any developed city in the world. You could argue the toss there, but they were certainly in the top handful, and they've struggled. They've put up land taxes and other things. They've struggled to balance their budget through big labour spending down there that hasn't caught up. Now, Melbourne will have its time as well, just like everything has its time. Over 10 years, you can see Melbourne at 40%, so it still had some growth. Darwin very low over the 10 years. The highest one there over the last 10 years is Adelaide, which you would not have predicted 10 years ago. Adelaide was seen to be a stagnating city, but it's been replenished. You had people move from Melbourne that had had a cracking 10 years of growth to Adelaide for affordability, and they attracted other people retiring or downsizing. So the markets have a way of averaging out in the long run. So both we and Performance probably believe Melbourne's coming in that zone where it'll probably deliver above average returns over the next 5 to 10 years. Who knows what the average returns will be, but Melbourne, just on catch up alone, will probably be better. We still think there's attractive bits elsewhere, including Perth and Southeast Queensland, but they've had a good run. But I should note Perth, Southeast Queensland are amongst the highest growing areas in Australia, and that population growth creates shortages, which creates boom. And you've got certainly for Southeast Queensland, you got people moving from Melbourne and Sydney, where average prices are still higher than Brisbane and Sunshine Coast and Gold Coast. So that is underwriting the market up here at the moment. And as long as we're under where Sydney prices are, then that is likely to continue. Not necessarily the same rate. There's those averages again. So you see the growth rates over time, 6% over the last year, and that massive jump we had where properties grew, nearly 25% following COVID. And it'll be interesting to see where that settles. In terms of the capital cities, you can see the growth for the last year at the different regions around Australia. So, country South Australia on the leaderboard there at 12.3%. Who would have picked that 10 years ago or even a year ago? So, and this is a good thing because one of the solutions to housing affordability is to have more people move to regional areas, and in the case of remote work. And the more people that do that, the more it creates for local work as well. So I think that will be a natural market-driven solution. Not everyone wants to move to the bush, but if some people do, that certainly helps. At the bottom end of the market, you've got ACT and rest of Victoria. So low end at 2% over the year to September. And then some solid performers in Brisbane, rest of Queensland, Perth, rest of WA as well, and Darwin, a bit of a comeback, but it has been a laggard over the last 10 years, so maybe small. I know Darwin's a capital city, but it's got a population that's smaller than the Sunshine Coast, so I don't really consider it a capital city property market, more a regional market. And the 12-month changes to dwelling values there once again, and that combined averages. Loans, you can see the downward trend, but I suspect, as I've mentioned, that's kind of going to stop where it is. You can see the 5-year rates, not too much higher than 1-year rates. Now, these are the averages. So on these, where we source this from Mozo, these are the averages. So wherever there's an average, you're going to have some that are higher and some that are lower, but you're starting to see 5-year rates in the low to mid fives, which is not a bad rate if you can lock it in for investment properties. Variable loan rate, that's the headline average rate, but we're seeing best rates should be at least 0.5% under that in the mid fives at the moment. If you're paying too much, yell out. We can give you tactics to either talk to your bank or give you people to talk to if you want to sharpen up your borrowings. And our updates on performance property, you can see there Melbourne starting to enter that buy value zone. And it looks to be a solid blue chip. And it's interesting that country Victoria is following that. It's still at the end of the stagnation stage. Keep in mind, this is not a perfect science. This is some really smart people with good data's best interpretation. We value their interpretation a lot. We also look at Heron Todd White, who come at it from a different angle. They're the nation's biggest property valuers. So they're looking at what's happening, not so much the potential. And it says Melbourne's still declining. So Melbourne hasn't floored, but it's now into that zone where you start to say, wow, it looks really cheap. I've got some properties in Melbourne. I'm certainly not selling. And if I was buying an investment property at the moment, I would almost for certainly be looking at Melbourne as an easy solution, subject to doing the numbers as always. If you've got any questions on that, yell out. That sums up today, and as always, I'll sum up that all our investing is best done as part of a real plan with goals, with a clear picture of where you're at and the portfolios and investments designed to meet and achieve those goals. We take a long-term view, and that's allowed us to generate really good results during a crazy decade. It's nice to be sitting. I think our balance fund's about 3% above the averages over the last 10 years. That is a massive difference to the portfolios that we look after, and that's without taking crazy risks betting on stuff. and in keeping you informed all the way through. And we do that with our low cost access to index funds for most markets, with occasional diversions from that where we think it's worthwhile. I've already talked about the protection with the reserves and the dollar cost averaging and those three ways to lose money. Till next month, hope you have a great month. News update for I'm poised at the moment. My daughter Laura, who many of you know, who's worked in and out of the business over the last decade, is about to give birth to a little girl. So next month, when I talk, I'll be a grandfather, and we're expecting that. It's due tomorrow, actually, but who knows when she arrives. So that's my focus for the month. Till next time, Rob McGregor signing